Good morning, everyone. Welcome to an episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is Unmet Expectations. Despite the rate cut last week, the dollar was sent higher, with the DXY up around 0.6% as USD yields climbed higher. Admittedly, higher yields came on the back of a string of better-than-expected economic data in the US, with US GDP data being upwardly revised on stronger household consumption, while initial jobless claim data dipped to alleviate fears of a sharp labor market deterioration. Fed officials were also sounding cautious, with most reiterating that their rate cut was an insurance move and that there may be discomfort around rate cuts going forward. Governor Stephen Miran stood out in stark contrast, with his allusion to neutral rates and that policy can be 125 basis points lower by year-end. Meanwhile, there was little rest on the tariff front, as President Trump ramped up threats on pharmaceuticals, saying that branded or patented pharmaceutical products will be subjected to a 100% tariff starting 1st October unless companies have broken ground on a US manufacturing plant. Tariffs on furniture and heavy trucks were also threatened. On that note, Korea has continued to stress on the need for unlimited FX swaps in order to implement their investment deal with the US. The double-edged sword nature of FX markets is very apparent, as President Lee also said that South Korea will be extending Korean won trading to 24 hours next year, which will reform capital markets and assist in their efforts to upgrade their market status to a developed one by MSCI. Nonetheless, deepening capital markets will also support enhancing Korean won stability. In Japan, BOJ minutes, as well as former BOJ board member Sakurai, generated further expectations of rate hikes, but the yen defied these expectations, pressured by higher USD yields. In Asia, political and fiscal stability was all the focus. In Malaysia, fuel subsidy rationalization last week fell short of earlier expectations, but remained a welcome step. In the Philippines, the peso had a sharp underperformance as an ongoing corruption probe triggers fears of slower government spending and slowing economic growth. In Thailand, Fitch has joined Moody's in cutting Thailand's credit rating outlook from stable to negative. And newly sworn in Prime Minister Anutin has pledged to reframe and revamp the fiscal framework, even as it looks set to announce more stimulus next week. For the week ahead, amid Australia's CPI printing on the upside, the RBI looks set to stamp pad on 30th of September and transmit a message that markets ought to slow down on their expectations of rate cuts. That said, the RBI may be forced to acknowledge a material slowing of labor market conditions. In India, our expectations are for an out-of-consensus RBI rate cut in consideration of growth risks, but it will be a close shave given rupee depreciation pressures. All in, we remain wary of the multitude of rates in EM Asia. While higher USD yields may dent across the board ahead of NFP, unmet fiscal expectations in Thailand, corruption probes in Philippines, and intervention limits of Bank Indonesia ought to be closely watched in the week ahead. For more information, please refer to our week ahead publication or contact your respective sales desks and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.